Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
Bring me a dream.
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
You only have a little over 3 months to do something about how much in taxes you're going to pay on your income for 2025. So you better stock up now while supplies last, and the most tax-laden asset you own is probably your IRA or your 401k. So naturally, you're probably considering converting to a Roth IRA so that money can grow tax-free. But is converting these accounts to a tax-free Roth a no-brainer? Well, that's what we're going to cover today as we look at, should you convert to a Roth now that the big beautiful bill is law? Good morning. I am David Hollander, your host. This is Protect Your Assets. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman. You hear the jingle. That's because I help you sleep well at night by not worrying about your taxes, your legal issues, or the financial markets. And that's because I've been running a tax, legal, and financial firm for over 30 years. We are live right now. So if you have a question, you want to ask me anything related to those subjects, email me at questions@pyaradio.com. Again, questions@pyaradio.com. If keeping your tax rate low is important to you, well, you're probably considering converting your IRA or your 401k to a tax-free Roth IRA right now, particularly because tax rates were just frozen and will stay low for much longer as it looks like the new law passed and everything's good when it comes to paying less in taxes. So we're going to explore whether or not you should convert your 401k to a Roth IRA, and if you do, how much should you do it? Because there are arguments for and against Roth conversions, and so you don't want to miss a single second as we explore this controversial subject right now, given the fact you've got about a little over 3 months this year to take advantage of the new rules that just passed for 2025 when it comes to your taxes. With that, markets are at all-time highs right now. Is this an ideal time to convert your IRA or your 401k to a Roth IRA, particularly now that the big beautiful bill has some extra deductions here in 2025? Is this a good idea, or is there a catch? Find out before it's too late for you. You're listening to the Protect Your Assets show. I am David Hollander, the Sandman. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
With the Dow Jones and the S&P 500 being up this year, it could be a great time right now to convert part of your tax-deferred IRA or 401k to a Roth IRA here in 2025, particularly now because taxes are on sale. Right now, the tax rates have been locked in, and there are some deductions that you can take now in 2025 that are new. This is a result of the big, beautiful bill. And if you don't take advantage of them this year, you lose them. It's just that simple. So when you consider that your most tax-laden asset is probably your IRA or your 401k, naturally you're considering converting part of it, or in some cases all of it, to a Roth IRA that grows tax-free. Because if taxes do rise eventually at some point in the future, you want something that is tax-free, and that's where Roth accounts come into the equation. But is converting your tax-deferred IRA or your 401k to a tax-free Roth really a no-brainer? Well, it's a great question, and we're going to talk about it this morning. So let's begin by simplifying exactly what a Roth conversion is and how it differs from a Roth contribution. For 2025, you can make a Roth contribution if you make less than $165,000 as a single tax filer. Or if you are married and you file jointly, as long as you make less than $246,000, then you can contribute, again, these are contributions, to a Roth IRA in 2025. Now, the question is, well, how much? Well, again, a contribution amount, if you're under age 50, maximum is $7,000. And if you're over 50, they give you another $1,000. So you could put away $8,000 into a Roth IRA contribution account. Seems pretty straightforward. Well, what's a conversion and how is that different? Well, a Roth conversion is different than a Roth contribution. Taxes aren't due until April 15th of next year. If you take a distribution, say, out of your 401k or IRA and convert that into a Roth, even if you make more than the above income limits I just covered, so let's say you're married filing jointly, you make about $300,000 a year, obviously you can't make a contribution because you make too much money. But you still can do a conversion because there is no limit, no income limit on a conversion. And since the amount you convert is considered taxable income, you may want to consider converting only the amount that would bring you to the top of your current tax bracket, or possibly the next bracket if you can see that later in life, when you add in things like Social Security, the required minimum distribution off that 401k account later, and maybe you have a pension or rental income or other things, specifically if you paid down your mortgage and things like that, that will subject your income to a higher tax bracket. Let's look at an example to try and make this a little clearer. If you make between $206,000 and $394,000 right now, and you're married filing jointly, the current federal tax bracket on that amount of income is 24%. So you would pay 24% federal income tax on your converted amount. Well, what does that mean? Well, let's say that you pull out $125,000 from your 401k. You're going to pay ordinary income taxes on that of 24% if you're in that 206 to 394 tax bracket. And then you invest the difference into the Roth IRA and have that money grow tax-free for possibly 20 plus years. Likewise, let's say you normally take an RMD from your retirement account. Question, should you take that amount this year? Well, yes, you have to. It's required, and you have to pay the current ordinary income tax on that, even if you convert it into a Roth. But what if you don't need it? Should you do this? Well, maybe. Your federal tax rate in the example is 24% right now. What's it going to be in the future? I don't know. It could be higher, right? Well, the current deficit, the current expenditures that are out there with Medicare and Social Security, who's going to pay all this back? Well, most likely we are with taxes. So that's another thing that just came out through the big beautiful bill is the new estate tax limit for 2026. It's now $15 million per person. This is now permanent, and that would be $30 million for couples. Sounds like a lot of money. Now could be the time for you to file what's called a 709 gift tax return, and you could set up for your family a family limited partnership. We call these flips in the legal profession. You might want to do that to lock in that wealth for your family for multiple generations, because the estate tax is 40% on any dollar that's subject to an estate tax. So if you set up things now that take advantage of this $15 million exemption, well, your family could get all of that money estate tax free if they did this correctly. So now's a great time to take advantage of those sort of things. Going back to the Roth conversion example I was just talking about a minute ago, would it make sense to do that Roth conversion if you made between 206 and 394? Well, just taking a look at the 2025 tax brackets, you can simply Google these and look at them. You'll see that over 394, the next stop is 32%. So for every dollar over 394 that you would pull out, you would jump up roughly another 8% in tax on the federal side of the taxes you pay. Does that make sense? Well, it might, particularly if you look down the road and you see that with all of those incomes, you could be in the 37% tax bracket as it exists now, or if they were to lower income rates like they were just a few years ago, you might be in a higher bracket just because of that. So if you're really interested in preserving, say, the 12% bracket, because maybe you're making $50,000 to $60,000 a year and you might want to pull out, say, $30,000 and do a conversion and pay 12% on that, well, that's the kind of strategy that you could use right now to lock in these lower rates and pay taxes on that and let that money grow longer term. Remember, a big part of this is that you have the time to let that account, hopefully invested correctly, grow over time so that money grows tax-free, and when you go to pull it out later, it comes out tax-free, and hopefully at that time, like I said, you would be in a higher tax bracket. All of these things are very important to think about before you do any conversion. So simulating this sort of a thing is very, very important before you make any move, because again, all of these numbers could affect you in both a positive or a negative way in the future, but unless you're really looking at it, how do you really know? Well, here's what we've done. As a result of the big, beautiful bill, we've put together a retirement checklist. It's a simple PDF document. I could email that to you right now. It's really quick, takes about 5 minutes just to look through this, but there's some things that you might miss if you're not aware of what they are here in 2025. So if you would like this, we're going to go ahead and send that to you right now this morning, absolutely complimentary. Just give us a call, 866-PROTECT, that's our phone number, 866-776-8328. Again, 866-PROTECT. Give us a call. We'll go ahead and send you out this checklist right now. My team is working here on a Saturday, ready to help you. Give them a call, 866-PROTECT, and get your retirement checklist. Now, coming up next, it's time for our popular They Say segment, where we'll explore how converting your retirement account to Roth may cause you trouble with your Medicare premiums. And later, we will share how to decide on how much you should consider converting to a tax-free Roth IRA, and we'll explore other benefits to owning a Roth. So much more is coming your way here on Protect Your Assets. Stay with us. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And if you missed our market segment at the top, where I was giving you some ideas on what you can do with this market at all-time highs and where some opportunities are right now, well, go check out our podcast wherever you get your podcasts. You just type in Protect Your Assets, and then you'll see two different shows, I guess. One is the one that has the little Sandman character on it, and that's the content that we're talking about today, like Roth IRA, should you convert. The other one has a profile of my face, and it's the market segment, and that's about 4 to 5 minutes in length, no commercials, obviously, and we talk about the market predictions and things that we're seeing developing. So I talked about that this morning, and I gave you some ideas of where some value could be given the yield curve that's setting up right now with the 2-year Treasury versus the 10-year Treasury and the Fed and all the controversy that's going on right now. There are some areas that look pretty interesting. So if you missed that market segment, go to where you get your podcasts, check out the Protect Your Assets market segment. And if you like what you hear, please share it with a friend. I would appreciate that. So there's no argument right now that the federal deficit has grown and continues to grow higher. And so the question is, are taxes going to be higher in our future? Well, don't forget, midterms aren't that far off, so I guess we'll see what Congress ends up doing about it. But if you're like me and you believe that taxes just went on sale as a result of the big, beautiful bill, then right now you should be doing everything you can this year before this year runs out. Can you believe it? We just have a little over 3 months left in 2025. And now that the big, beautiful bill is law, there are some good deductions that just got passed into law that are only available this year. And if you don't take them, you lose them. It's just that simple. So since tax savings are here now and it is the law, you need to look at where you can take advantage of those as it relates to your income and your plans for the future when it comes to your retirement income. Now it's time for one of our fan favorite parts of the show. This is our They Say segment where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All I know is that I don't know.
All right, so here's one they say. They say that you should convert as much of your IRA or 401k into a Roth IRA as you can. But is that really true? Is it a no-brainer to do that? Well, for some people, the answer is yes, but for others, the answer could be no. It really depends on how much you convert to a Roth. See, when you convert your taxable retirement account, like your IRA and your 401k, to Roth, that increases your taxable income for the year that you do that. And this also may increase your Medicare premium. Well, let's look at how your Medicare Part B premiums can increase for a year when your tax return shows more income because, let's say, you did a Roth conversion. Some specifics. If your modified adjusted gross income is above a certain amount, you pay an income-related monthly adjustment amount. Whoa, that's a mouthful. Write this down. We call that IRMAA, I-R-M-A-A. Again, I-R-M-A-A. Kind of sounds like a cousin, right? Medicare uses the modified adjusted gross income that's reported on your IRS tax return from 2 years ago to figure this out. This is the most recent tax return information provided to Social Security by the IRS. So the standard Part B premium amount in 2025, this is what most average people pay, it's $185 in 2025. Most people pay the standard Part B premium amount. If your modified adjusted gross income increases, because, say, you did a Roth conversion, then you could be charged IRMAA to your premium. This is, again, something related to income that affects your Social Security and your Medicare. How? Mainly Medicare. Let's look at some examples. If your income in 2023, because remember, they go back 2 years, and so you're going to be looking at what you would look at on your 25 return when you file. If you're single and your individual tax return was above $123,000 up to $153,000, or you were married filing a joint tax return and your income was above $246,000 to $306,000, then instead of $185, you're going to pay $329.70. That's right, per month. This is quite a difference, isn't it? And that's how this thing gets calculated. Let's look at some other examples. Let's say that you're single and you made between $153,000 or $183,000, or married filing jointly and you made above $306,000 up to $366,000. Well, now you're paying $428.60 a month. Another pretty big jump. Well, it gets even better. Let's say that you're single and you had a good year, or you did a conversion and now your income went up over $500,000. Or you're married filing jointly and your income now with the conversion is over $750,000 because maybe you went ahead and converted that entire 401k without knowing about this. Well, now your Medicare Part B premium is $560.50 a month. That's right. And that's a lot more than $185, which is the average. So this IRMA thing is real. And if you're not paying attention to this as you do your conversions, well, that could be a big problem for you. So what you want to do is you really do want to use the simulator that your accountant or your enrolled agent in combination with, say, your financial planner, can map out to explore what are some of the penalties if you go ahead and take advantage of this here in 2025. And what I mean by that is, sure, there are some extra deductions that exist now, depending on your age, under the big, beautiful bill that you could take advantage of right now in 2025. These are things you can do today that when you go to file your taxes April 15th of 2026, will be an advantage to you. In other words, you could pay less taxes on things that you want to do now, convert some of that money into Roth, invest it in a portfolio that makes sense for you over the long term, and let that money grow tax-free years and years and years. And then later, if you need it and you want to take it out, it will come out tax-free, and you won't be subject to any required minimum distribution on that amount of money. Moreover, when you pass, if there's money in that account, your spouse could roll that over to themselves, and that money comes out tax-free without any sort of a mandate on when they have to take it out. And then when the last of you dies, you can pass that on to your kids, and they then can take that out tax-free. But keep in mind that there is a 10-year rule on full distribution of that account when it passes to that next generation. So these are all things that you can map out in your simulated retirement plan right now. You can simulate how much in taxes you could pay here in 2025 just by, again, adding in some of these deductions, adding in some of these contributions you might make if you're under certain income thresholds, as I talked about in the previous segment, or if you decide to convert some of your 401k or your IRA to a Roth. Figure out how much in tax savings you would have off of that money if you converted. But also don't forget about this IRMA premium, because if you did one thing that caused something else, like paying $560 a month in Medicare Part B premium, you know, that $400 difference roughly might not make it worthwhile, right? Because now you're paying almost $5,000 a year for extra health insurance that you wouldn't have had to pay if you didn't do this. So these things are important to look at and think about before you just go ahead and do anything like what I'm talking about. We have tax CPAs on staff, we have estate planning attorneys, and we have certified financial planners who all work together as a team to help you navigate and project out these things that I'm talking about. We have lots of experience, been doing this for over 30 years. And our team works together to help you. Well, if you have your own person that you like your CPA or your advisor, that's okay too. We can work with them. Call us right now and get a second opinion by getting my retirement checklist. This is something that we put together that goes through all the latest things with the big, beautiful bill that you need to know about right now. Over the next 3 months, you have a little bit of time left in 2025 to do something about it and take these deductions, but you have to know what they are. You have to know where to look. So again, this is something easy. We can email you quickly. You can take a look at it, see if you're taking advantage of these new rules, and if you're not, well, you can do something about it. Call this number, 866-PROTECT. Again, the number to get your free retirement checklist, 866-776-8328. My team is standing by right now on a Saturday. We're working today. Call us, 866-PROTECT, and get yours. Coming up next, how do you decide on how much you should consider converting to a tax-free Roth IRA? Well, the answer's coming up next. We'll be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com, where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman around here, and you are listening to Protect Your Assets. And with markets at all-time highs, you're probably wondering, when will Humpty Dumpty fall off the wall? Well, we were talking about that this morning. We're giving you some ideas about what you can do with your investment strategy. Go check out our podcast and listen to our market segment, where you'll get the latest ideas and what we are doing. But also, with stocks at all-time highs right now, is now a good time to do a Roth conversion. Well, we've been talking about that this morning and some things you should think about if you're going to do that. And during today's episode, we've been sharing if a Roth IRA makes sense and what you should know before you convert to a Roth IRA from your 401k. So, two things may determine how much you can afford to convert from a traditional account like a 401k to a Roth IRA in a particular year. Well, the effect on your tax return and the money that you need to pay the taxes on the conversion amount are two things that you definitely want to know about before you start down the road of a conversion, because the conversion amount that you do will be added to your taxable income. And this could potentially bump up your tax bracket, wherein you end up paying a lot more money on the income, and as I was talking about earlier, on your Medicare tax as well. So, to stay within the same tax bracket, the most you could convert is the difference between your current tax bracket's highest end and your pre-conversion taxable income. So, let me make that make some sense. For a married couple who files jointly in 2025, let's say your taxable income is $100,000. Okay, well, you pay 22% in federal taxes, and therefore you could convert up to $106,000, $106,700 to be exact, without hitting the next tax bracket, which begins at $206,700, and every dollar you earn over 206.7 is taxed at 24%, or 2% more in federal taxes than if you were below the 206.700 number. Does that make sense? Okay. You can also spread out the amount you want to convert. This is where strategy comes into play, over several years to minimize the tax impact, which, of course, can be painful if you're not looking at that. That same couple that converts $106,700 could potentially owe $25,608 in federal taxes on the conversion amount if they have only made deductible contributions to, say, a traditional IRA. The IRS doesn't want you to pick and choose which types of contributions are used for the conversion. Instead, a ratio of pre-tax to after-tax assets for all IRA accounts is used to determine how much of the contribution should be taxed. Earnings, of course, are always taxed. So if you have a regular 401k and you are retired, the IRS allows you to roll over, not convert, only after-tax contributions directly into that Roth IRA, eliminating the tax bill on the rolled over amount. Keep in mind, if you pay the taxes for a Roth conversion using money from an IRA, the IRS considers the portion used for taxes as a distribution. And in that case, taxes and a 10% penalty, that's right, 10%, could be charged to you for any early withdrawal if you're under the ages of 59 and a half. Whenever possible, use savings from a non-retirement account, like your bank account that earns very little in interest probably, to pay the tax man that I was talking about earlier, that $25,000 tax. That's a lot, right? No matter how foolproof your plan may seem, consider what could go wrong. If the beginning of this year has taught you anything, the reality is anything can happen with the president around. Tariffs falling out, a new federal chairman, war, you name it. Seems like the news just keeps coming. That's why when it comes to this sort of idea, Roth conversions, you should talk to a tax professional and your investment advisor to help determine what you will owe before deciding how much you want to convert. We do taxes, we do law, we do finance here at the Liberty Group. We work as a team together in our offices. You can sit down with all three of those folks, find out what makes sense before you do anything, and see how we can help you. We work with family businesses. We're very familiar with real estate, and we most likely can help you with your small business. It all starts with a 15-minute checkup, and if you'd like the checklist, call us right now. Our staff is standing by, 866-PROTECT. Get your checklist right now, 866-776-8328. I'd like to give a big thanks to the Protect Your Assets team for a great show today. Executive producer, Kevin Renfer, my network manager this morning, Raf, and of course all my fabulous producers back there, Lucas and Dylan. Thanks, guys, because without my team, I'm just another pretty voice on the radio. You have been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.